Most people do not feel the fixed income trap all at once. They feel it quietly, in the space between what comes in and what still has to go out. It begins with a simple change. The paycheck is no longer as flexible as it once was. Maybe work has slowed down. Maybe retirement is getting closer. Maybe Social Security, savings withdrawals, part-time income, or a pension now have to carry more of the household than they used to. And at first, it may not look like a crisis. The lights are still on, the car still starts. The bills are still being paid, life still looks steady from the outside. But inside the month, something feels tighter. The grocery bill does not feel fixed. The insurance bill does not feel fixed. Medical costs do not feel fixed. The rent, mortgage, utilities, credit card minimums, car payments, and repairs do not politely adjust themselves just because a person is getting older. And that is the quiet problem after 60. Income may become fixed, but life does not. Retirement is supposed to feel lighter. After decades of work, people imagine slower mornings, fewer deadlines, less pressure, and a little more room to breathe. But for many Americans, the feeling is more complicated. The paycheck may slow down, but the bills keep moving. And when that happens, retirement can begin to feel less like relief and more like another version of the same monthly pressure. According to the 2026 Retirement Confidence Survey from EBRI and Greenwald Research, retirement confidence declined, with concerns about inflation, debt, healthcare costs, housing expenses, Social Security, and Medicare weighing on both workers and retirees. Only 64% of Americans felt confident they had enough money to live comfortably throughout retirement. That number carries more than financial meaning. It carries fear, pride, silence, and the private worrying that many older Americans do not say out loud. I may have income in retirement, but will I have breathing room? In January 2026, the estimated average monthly Social Security benefit for all retired workers after the cost of living adjustment was $2,071. Social Security can be an important source of income for many older Americans, but it exists inside a real monthly budget. In 2026, the standard Medicare Part B monthly premium was $200.90, with a Part B deductible of $283. Those numbers matter because they remind us of something simple. Retirement benefits do not arrive in a world without bills. The budget keeps moving. In 2024, average U.S. household spending was $78,535, or about $6,545 per month. Housing alone averaged $26,266 per year, or about $2,189 per month. Transportation averaged $13,318 per year, or about $1,110 per month. Housing and transportation together accounted for more than half of household spending. For someone still working full-time, those costs may already feel heavy. After 60, they can feel different. Not because older people stop needing transportation. Not because the house stops needing repairs. Not because food, utilities, insurance, or medical care become optional. They feel different because the income side of the household may no longer have the same room to stretch. A younger worker may still imagine overtime, a raise, a bonus, or more years to recover. After 60, time starts to feel different. Risk feels different. A bill that once looked normal can start to sound like a warning. Total U.S. household debt reached $18.8 trillion in the first quarter of 2026. Mortgage balances reached $13.19 trillion. Auto loan balances reached $1.69 trillion. Credit card balances stood at $1.25 trillion. Those are national numbers, but the pressure behind them is personal. It is the mortgage that still has years left, the car payment that still arrives every month, the credit card balance that began with groceries, medicine, gas, or a repair, the insurance bill that rises at the wrong time. The medical cost that becomes a payment plan because there is no easy way to absorb it all at once. And this is where many households begin to feel trapped, even when they are still doing their best. A mortgage can represent stability, but it can also become pressure. A car can represent independence, but it can also become another monthly claim on income. A credit card can begin as a temporary bridge, then quietly become part of the permanent budget. But the real problem is not always the bill itself. The real problem is what happens when the bill survives into a season of life where income becomes less flexible. That is the hidden cause behind the fixed income trap. Monthly payments have a way of softening the truth. They make large costs feel smaller. They make difficult decisions feel manageable. They change the question from, "What will this cost over time?" to, "Can I carry this month?" Sometimes that question is necessary. Sometimes it is the only question available. But if too much of life is built around monthly payments, the future can become crowded before a person arrives there. The car payment fits. The credit card minimum fits. The insurance premium is unpleasant, but necessary. The medical bill can be divided into pieces. The groceries, utilities, fuel, and phone bill have to be covered. Each payment may make sense by itself, but together, they can create a life where the income is already spoken for before it even arrives. What makes this dangerous is that it feels normal. And after 60, normal payments can become heavier. Credit card debt shows this clearly. According to Consumer Financial Protection Bureau credit card market data, general purpose credit card APRs averaged 25.2% in 2024, while private label card APRs averaged 31.3%. Consumers were assessed $160 billion in credit card interest charges in 2024, up from $105 billion in 2022. Interest has a quiet way of keeping the past alive. A balance may have started with groceries, medicine, gas, a car repair, or a month when the numbers simply did not work. But if it remains, the old problem becomes a new monthly obligation. It keeps returning, long after the original emergency has passed. AARP reported in 2025 that 47% of adults age 50 and older who are carrying credit card debt had used credit cards for basic living expenses they could not otherwise cover. AARP also reported that 17% of adults age 50 and older with credit card debt relied on cards for basic expenses every month over the prior year. That changes the emotional meaning of the debt. This is not always about careless spending. Sometimes it is groceries, utilities, gas, medicine, repairs, family needs, the ordinary costs of staying afloat. Debt may begin as survival, but if it stays long enough, it can become pressure. Bankrate reported that 29% of Americans had more credit card debt than emergency savings heading into 2026. That is the kind of fragility that turns one unexpected bill into a lasting balance. A repair becomes a statement, a medical cost becomes a monthly payment. A higher insurance bill squeezes the grocery budget. And when income is fixed or less flexible, there may be fewer ways to absorb the shock. This is where fixed income meets moving costs. The Federal Reserve's 2025 Household Well-Being Report found that price increases remain the most common financial concern. Rising prices do not ask whether someone is retired. They do not ask whether a household already has a credit card balance, a car payment, a medical bill, or a thin emergency fund. They show up anyway, in the grocery aisle, the insurance notice, the utility bill, the pharmacy receipt, and the repair estimate. For many households, the fear is not about wanting an extravagant retirement. The fear is much simpler. They want the numbers to work. They want the mortgage or rent to fit. They want the grocery bill to stop surprising them. They want medical needs to feel manageable. They want the car to keep running without creating another balance. They want the credit card statement to stop feeling like a shadow from a past emergency. They want to believe that after decades of work, life might finally have some room in it. But when income becomes fixed and costs keep moving, even ordinary bills can begin to feel threatening. Imagine Linda, a fictional 64-year-old. She receives Social Security and still works part-time. Her rent, utilities, Medicare premium, groceries, and credit card minimums are all part of the month. She is careful. She is not living extravagantly. But every month feels crowded before it begins. The income arrives, and almost immediately, it has somewhere else to go. Imagine Robert and Elaine, a fictional couple, 61 and 59. They are approaching retirement with a mortgage, one car payment, insurance bills, and a credit card balance from medical costs and home repairs. They are not chasing luxury, their worrying is quieter. They wonder whether retirement will feel smaller because old payments are still waiting. Imagine Michael, a fictional 52-year-old. He still has steady income, but during expensive months, credit cards help cover groceries, utilities, insurance, and family costs. The payments feel manageable now, but he wonders whether they will still be there when he reaches his 60s. He is not only thinking about this month, he is starting to see the shape of later life. These examples are fictional, but the pattern is real. The fixed income trap often begins years before retirement, when payments feel normal, balances feel temporary, and future income still seems flexible enough to handle everything later. Then later arrives. And the real consequence is not only financial, it is emotional. A household may still be paying every bill and still feel no peace. A person may still be getting by and still feel afraid of one mistake. A couple may still look stable from the outside and still feel privately trapped by the math of the month. The issue is not always income alone, it is the pressure that income must carry. Social Security, savings withdrawals, pensions, or part-time work may provide money. But that money still has to face housing, transportation, groceries, utilities, insurance, credit cards, medical costs, and emergencies. If too many obligations survive into later life, the household may feel squeezed even when income is still coming in. That is why this trap is important to name. It is not a prediction. It is not a judgment. It is not saying every person after 60 is struggling. Every household is different. Some have more savings. Some have less debt. Some have pensions. Some keep working. Some own homes outright. Others are still carrying obligations. The point is not to force everyone into the same story. The point is to see the pattern before it becomes invisible. When income becomes less flexible, old payments matter more. When savings are thin, emergencies matter more. When prices rise, fixed budgets feel tighter. When credit card balances remain, interest keeps the pressure alive. When health costs arrive, retirement feels less predictable. And when all of those pressures meet in one household, even a responsible life can feel fragile. This is not a message of shame. Shame keeps people silent, and silence makes financial pressure feel heavier than it already is. Many people carry these worries privately, believing they are the only ones who worked hard and still feel behind. But the data suggests they are not alone. Debt is widespread. Retirement confidence has weakened. Older adults are using credit cards for basic expenses. Many Americans have more credit card debt than emergency savings. Price increases remain a major concern. These are not isolated fears. They are part of the financial landscape many families are trying to cross. The deeper lesson is simple, but not easy. Fixed income is not only about how much money comes in. It is about how much pressure that income must carry. That question can be uncomfortable because it touches pride, regret, time, and fear. But it can also be useful. It turns a vague worrying into something visible. It gives a name to the feeling that life is still moving, even when income no longer moves the same way. Retirement is not just an age. It is not just leaving a job. It is not just a number in an account. Retirement is a monthly reality. It is the bills that arrive, the income that comes in, the costs that change, the old balances that remain, and the emergencies that do not wait for permission. And in that monthly reality, breathing room matters. So the warning is quiet. Be aware of the payments that feel harmless while income is still steady. Be honest about the balances that feel temporary. Notice the costs that may keep moving after 60. Pay attention to the difference between income and breathing room. Because the fixed income trap does not usually announce itself with one dramatic event. It arrives softly, one bill at a time, one price increase at a time, one balance at a time. And by the time many people notice it, the income has become fixed, but the bills never did.